higher equivalent experience labor.
Yeah, I'm in Paulson, and the overhead projector came on, but it doesn't seem to be picking up the laptop, the lectern PC. Something must have been disconnected. So, great, thank you. Can't get the projector to pick up the screen, but I'll get started. So the quizzes are upstairs in case you want to pick them up there. I think about half of you have picked them up. So if you can pick them up, great. Today, we're going to start in the second packet. I sent you a couple of reminders to download it. So if you did already, great. If not a big deal. Do it by the end of the week because we're into the second packet. So if you think about where we are in the class, we've essentially looked at the investment principle. Okay? So let's review. The investment principle says you want to go out and take investments that earn a return that is greater than your minimum acceptable hurdle rate. Okay. And the sub principle is the hurdle rate should reflect the risk of the investments you're taking and should also reflect the mix of debt and equity. We capture that with the cost of capital. The risk is captured with the beta with equity, essentially looking at the risk. You cannot diversify away, at least for public companies. With private companies, we might bring in the rest of the risk. And the cost of debt is the rate at which you can borrow money today, long term. The returns we should be based on cash flows and time weighted. So that's just the present value factor. I think it's on. Maybe I didn't put them. Can you hear me now or no? Nothing seems. It's on now. Okay. So now let's look at the second big principle in corporate finance, which is the financing principle. I keep looking at the screen. There's nothing there. So look at your slides. Here's what the broad principle is, and this is what we're going to be fleshing out over the next 5 or 6 sessions. The financing principle has 2 parts to it. The first is looking at the mix of debt and equity. It says the right mix of debt and equity for your company, and it's very specific to you, is the one that minimizes your hurdle rate. And the second part of the principle says the right kind of debt for you is the one that reflects the business you're in. So if you're taking projects which are long-term, your debt should be long-term. If your cash flows are in dollars, your debt should be dollars, matching up the debt to your assets. So I want to start in that first part, the mix of debt and equity. And here's what I want to start with. There are 2 ways of funding a business, debt and equity. Let's delineate what separates them. So if you're a lender as opposed to an equity investor, what's different? Let's start with the cash flow claims. A lender gets a contractual claim, right? You get interest payment, principal payments. If you don't get paid, you can go to court, you can put the company into default. Equity gets a residual claim. I mean, yesterday I got an email from somebody who found what he thought was a perfect way of making money. It locked in this, found this company with a 12% dividend yield. Already you should be a little suspicious. In this market, if you find a company with a 12% dividend yield, it's a disaster probably waiting to happen. The prices drop and the dividend stays high. He had created this elaborate strategy built around the presumption that the 12% dividends would continue to get paid over time. He called it arbitrage, which tells you how loosely we use the word arbitrage. But he was borrowing money to buy the stock, and he was saying, I can make a guaranteed profit. What's missing here? And what's missing is the 12% dividend yield is not a guaranteed cash flow. You create a guaranteed payment to somebody because you borrowed money and you buy this 12% dividend yield stock. What if next year, and I think it's very likely, the company cuts its dividends by 50%? It's a residual claim. Second difference, equity investors get to run the company. In return for having the residual claim, you get to choose the board of directors. The management is accountable to you. Lenders in a healthy firm don't have that power. You can have veto power. You can put in covenants and restrictions on the company, but you don't get to pick the board of directors. Now, if you get into trouble, that could change. And the third is if you fail to make contractual payments to lenders, they can shut you down. You can go bankrupt. With equity investors, you don't have. One final component, this comes from the tax code, and this is going to play a very big role on this debt versus equity story, is debt provides tax benefits. It provides tax benefits because in much of the world, and we'll talk about the parts of the world where this is not true, interest is tax deductible. That 1 minus T we had in the cost of capital. So that's what separates debt from equity. The basic question we're going to start on today is what is the right mix of those two types of financing for my company? So let's step back. If you remember early in this class, I think in the very first session, I put up a corporate life cycle. Remember the corporate life cycle? You're a young company, you're a startup, is like a baby or a toddler, a teenager, a peak of your life, middle-aged, old, you go into decline in debt. Think about what will happen to this mix of debt and equity as you go through the life cycle. Very early in the life cycle, you're a startup. If you have a choice, sometimes you might not, what should you be using? Do you want to bind yourself to contractual cash flows or do you want residual cash flows? You want residual cash flows. It doesn't make sense for a startup to borrow money. As I said, you might have no choice. As a startup, you might run out of equity and go and borrow money, but it's always an option you should consider last. Because all your value is in the future. Why would you want to risk it by borrowing money and seeing it break down? As you move through the process, you're a toddler company. The business is starting to get legs on it. The revenues are building up, but you're still not making much money or losing money. And you need a lot of cash flows for future growth. It's still equity that dominates. As you get to be a mature company and your cash flows start to come in and you don't need to reinvest as much, your capacity to borrow money opens up. In other words, if you look at, tell me where a company is in the life cycle, and I'd like you to think about the company you're doing for your project. It's been a while since you thought about it, okay? But think about it and think about where you'd put in the life cycle. Don't look at any of the numbers and ask yourself, given where it is in the life cycle, how much debt would I expect that company to have? And be ready for surprises. Surprise in what sense? You might have a mature company that chooses not to borrow money. You might have a young growth company that chooses to borrow money. Remember Tesla in 2016, money losing company with immense potential goes out and borrows money. Sometimes companies, thank you. You guys on Zoom, are you still seeing my slides?
Yes.
Okay, good. So let me, this is not working. I'll come back and talk about it. So basically, you've got this life cycle issue. Tell me where you are in the life cycle. We can talk about what the right, does my sound also improve magically? God only knows what technology is doing. But basically, you can see the mix of debt and equity you will use changes as you go through the life cycle. So let me go back because now I'm going to talk a little bit about what you see out there, and then we'll see whether we can explain it. First, talk about a few things that you notice that are different about the mix of debt and equity that you use across the world. This is actually a graph that shows you how companies fund their growth in different parts of the world. So if you look at the US, for instance, the green part comes from net debt. That's new debt issues. The blue part comes from new equity. You're saying, what's this below? I'm sorry, the purple part comes from net equity, and you notice it's negative. Saying, how can it be negative? Because if your buybacks exceed your stock issuances, which has been true for much of the US for the last 30 years, net equity can be negative. And in the middle, you have internal financing, which basically is retained earnings. You can see already that in different parts of the world, the mix of debt, equity, and internal financing varies. And in the US, there's a much greater dependence on the part of companies on corporate bonds as opposed to bank debt. In fact, let's take a pause there and let's think about it as a company. Borrowing money through a bank borrowing as opposed to corporate debt. What are the pluses and minuses of using corporate bonds as opposed to bank debt? Yeah. Not necessarily. That'd be nice, right? Because then that's actually a suggestion that corporate lenders are much less caring about default risk than banks are. So on average, I don't think you get that much of a benefit.
You eliminate the need of having a bank syndicate and negotiating with a bunch of banks and just issue the bonds.
In other words, the tyranny of the local bank gets removed. There are parts of the world where if you don't have corporate bonds and you go to a bank and the bank says, 3-year fixed rate loan, and you look at your company and say, I think with my projects, I should be getting a 30-year floating rate loan. The bank says 3-year fixed rate loan, take it or leave it. With corporate bonds, you get more flexibility. You can build in more things into a corporate bond. And we'll talk about some of the more creative corporate bonds out there. So you get to design bonds that might reflect your choices. In some cases, the corporate bond market might be more forgiving of default risk than a conventional bank, which is the argument for lower rates. What else?
I would say that corporate bonds come with less covenants attached to it.
And the third is that corporate bonds tend to have fewer restrictions than bank loans. So it is good to have both choices. I'm not saying one always dominates. It's good to have both choices. In the US, you've had both choices now for close to 100 years. The corporate bond market in the US has very deep roots. You know, the corporate bond market predates the equity market in the US. It had much deeper roots. In fact, the reason lots of stocks paid dividends is they were competing with bonds for investors' money. So they had to almost had to disguise themselves as bonds, saying, look, we're really a bond. The dividend is your coupon. So corporate bonds are a choice that the US has always had. So when you look at a US company, you will tend to see more of its debt take the form of corporate bonds. 25 or 30 years ago, if you went to most emerging markets, there were no corporate bonds. It was bank loans or nothing. That game's changing. Today, you have corporate bond markets in much of the world. It still is true that the proportion of debt that comes from corporate bonds is less outside the US than the US, but the differences are starting to narrow. So with that setup, let me look at my 4 companies, because the first thing you need to do when you look at your company, before you start asking what kind of debt should my company have and how much debt should it have, is do an inventory of what they actually have. So I decided to do an inventory of my 4 publicly traded companies. You're saying, why don't you, I have 5, right? There's Deutsche Bank. You're saying, why don't you look at Deutsche Bank? What do we say about banks? That defining debt for a bank is almost impossible to do. So I'm going to take Deutsche out of the picture, take my 4 non-financial service companies. So I've listed out the total debt they have, broken down into interest-bearing debt and leases. And remember, in 2013, I had to convert leases to debt for every one of these companies. You're a little luckier. Now, when you look at it, you can actually see lease debt versus traditional debt. You're saying, why should you care? They're different kinds of borrowing, right? Lease debt is tough to pay off. It actually, you need to shut down whatever you've leased. So if you're a retail company with a lot of debt, it's all lease debt. The way you get out of lease debt is by shutting down stores. Traditional debt, you can raise new equity and pay it off. So that's the breakdowns. I'm sorry. Second, if you look at the proportion of corporate bonds and bank debt, what you saw on the previous graph comes through. 92% of Disney's debt is in the form of corporate bonds. But even Disney has 8% of its debt is bank debt. You will almost never find a company where all of the debt is corporate bonds. There's some debt where it's still convenient to take on bank debt. So if you have working capital financing that comes and goes, it's tough to create a bond that can do that for you. So even in companies where the bulk of the debt is corporate bonds, you're going to see some bank debt. If you look at Vale, 40% of the debt is corporate bonds. 25 years ago or 20 years ago, if you looked at Vale, all of their debt was bank debt. You're seeing the shift away from bank debt to corporate bonds. Tata Motors, 38% of the debt is corporate bonds. I was actually surprised it was that high. But part of that came from the acquisition of Jaguar Land Rover, which brought in corporate debt. And now Tata Motors is a much bigger user of corporate bonds. Baidu's debt is all bank debt, 100%. So differences across the four companies. If you look at maturity, and I want you to start thinking about, as I describe the maturity, does this make sense for this company? About 49% of Disney's debt is 1 to 5 year maturity. And then there's about 13% of its debt that's very long term. I'm not going to make the judgment yet, but if you think about Disney's mix of businesses, which of their businesses do you think uses that really long term debt? The theme parks, because they're big infrastructure investments. The movie business, much, at least on the face of it, it makes sense, right? That you've got this bimodal distribution. If you look at Vale's debt, it is the longest term debt by far of the four companies. And that makes sense too, right? Your typical project is an iron ore mine that lasts 25 or 30 years. Your debt is going to be long-term debt. Tata Motors, it's 58% of its debt is right in the middle, 5 to 10 year debt. Does that make sense? I don't know. No, because I don't know how long does a typical auto plant last? I would say more than 5 to 10 years. Why do they have so much midterm debt or short, this maturity of 5 to 10 years? Part of it might reflect the fact that historically they've borrowed from banks. And banks don't like to lend for 30 years or 20 years. At least Indian banks used to have maturities which kicked in 10 years. Beyond that, they wouldn't even lend. Maybe this just reflects a history. And Baidu's debt, 69% of their debt is really short term, 1 to 5 years. Which kind of makes sense. It's a technology company, things can change. So at least on the face of it, and we'll come back and take a deeper look at it, the debt looks like it's kind of okay. In fact, I could compute a weighted duration of this debt or weighted maturity and ask the question, does that make sense? I would strongly recommend when you look at your company and you have the debt, you look at the breakdown, what the weighted maturity of the debt is, which you might already have collected as information to get the market value of the debt. I'm assuming you computed the cost of capital of your company, which is a bad assumption, but if you did, the weighted maturity came into play. Now let's look at the breakdown of the debt into domestic and foreign currencies. Disney's debt, 95% of the debt is US dollar debt. 5% is foreign currency debt. I already sense a mismatch here. Remember when we did Disney's equity risk premium? We looked at how much of the revenues came from the US and how much came from outside. Does anybody remember that breakdown? It was 80, yeah, good. It was 82% US, 18%. It's higher now, 18% outside. It might be too early to pass judgment. There might be other factors here, but if your debt is 95% dollar debt, but only 82% of your operations are in the US, I want to ask questions. Why is that happening? Maybe you've got futures and options used to hedge the currency risk, but that does seem to be a mismatch. If you look at Vale's debt, 66% of its debt is US dollar debt. Only 34% is real debt. As a commodity company, what are your cash flows going to be in? They're all going to be in dollars. So commodity companies, you can see why the bulk, you'll still have some local currency debt because some of your basic core operations might be in Brazil, but you can see that Vale's dependence on US dollar debt makes sense. If you look at Tata Motors, 71% of its debt is Indian rupee debt. 29% is foreign currency debt. If this had been the case in 2008, I'd be worried. Why? Because in 2008, Tata Motors got almost all of its revenues in India. With Jaguar Land Rover in there, it actually does make sense. And the one thing I would actually expect, given that Jaguar Land Rover is growing faster than Tata Motors in India, is that the proportion of foreign currency debt should increase over time. And then when you look at Baidu, you notice that 82% of its debt is foreign currency debt. Where does Baidu get all of its revenues? 100% in China. This is a clear mismatch. So later, when we talk about the right kind of debt, we can ask, why is this happening? I'll tell you one reason why emerging market companies often, even if they have no foreign operations, borrow in dollars, borrow in euros. What's the facile reason that most CFOs give for borrowing in another currency? It's cheaper. The rates are lower. Remember when we talked about currencies, how much trouble this can get you into? You've got an entire market, Turkey, where every Turkish company pretty much does this. In fact, I've described the Turkish corporate setting as insane because you keep doing the same thing over and over again, expecting a different outcome. You're going to be surprised by the outcome again and again. Because here's what happens. Turkish companies borrow in dollars. All of their revenues are in lira. You're always one shock away from the entire market going into crisis, right? What has to happen? You have devaluation of your currency for whatever reason, a crisis, inflation, the lira drops by 25%. Every company is now on the verge of disaster. Every 10 years, you see Turkey go through this cycle. And every 10 years, they say, we don't know what happened. And they repeat the whole process all over again. And finally, I looked at fixed and floating rate debt. For the moment, I just wanted to look at the breakdown because later we're going to ask what kinds of companies should be using floating rate debt. But most of these companies, it's fixed rate debt. Now, Disney is about 5%, about 6% floating rate. Baidu is about 5% floating rate. But at least we're getting a sense of what these companies already have. My suggestion is you start with this for your company. Before you get ambitions and ask, what should this company do in terms of borrowing? Nail down what the company is already doing in terms of how much it's borrowing, bank debt versus corporate bonds, leases versus interest-bearing debt. And that's the advantage of working in a group is you can actually compare these mixes. That's where the interesting analysis happens, is not looking at your company in a silo. But you have 5 retail companies. Why is one 90% lease debt and another the 20% lease debt? It's going to give you some insight into their business models and why they end up with the mix that they do. So as you look at these companies, I want you to put them in the life cycle. My 5 of my companies, Baidu is probably the only growth company. So you should expect to have the lowest debt ratio. Let's see if that plays out. As these companies mature, you're going to see their debt ratios or the capacity to borrow money go up. Doesn't mean that they will go out and borrow money right away. Because like human beings, they want to be young again. Every maturing company thinks it can go back to being young again. So it takes them a while to finally wake up and saying, this isn't going to change. Any questions on the corporate life cycle? Because we're going to now set up the discussion of the mix of debt and equity. Now, this is something you've already run into in the estimation challenges you've faced so far. When we talk about debt ratios, be very careful because debt ratios can be defined in lots of different ways. You can take debt as a percent of equity, debt to equity, and you can take debt as a percent of capital, which is debt plus equity. And even in your calculations, you notice how you go back and forth. When you do levered betas, you do the debt to equity ratio. When you do the cost of capital, if I'm hitting a sore spot, just let it go. When you're doing the cost of capital, you move to debt to capital. Debt ratios can be computed in book value terms or market value terms. Almost every debt ratio you will see coming from a service. You go to Yahoo Finance, and it reports a debt ratio of your company, will be a book debt ratio. Why? Because there's this fixation with book equity as something meaningful. The debt ratios we talk about in finance are almost always market debt ratios. The book debt is kind of irrelevant. The book debt you might be able to get away with, but book equity you definitely cannot. So what I'm doing is laying down the markers. When I say debt ratio, what I mean a market value debt to cap ratio. And if I want to say debt to equity, I will specifically say debt to equity. So let's set up the trade-off on what, on what you're looking for here in terms of determining whether you should borrow money or use equity. What are the benefits of borrowing money? What are the costs? And when does that trade-off lead you to borrow more money? I'm going to start off by knocking off some of the reasons people give for borrowing money that look pretty interesting when you look at them, but you take a deeper look, they go away. I'll tell you the most common reason I'm given by companies for borrowing money. It's a variant of the currency thing. Debt is cheaper than equity. That's always going to be true, right? Why is it going to be true? Because the lender is in front of you in the line. He gets that contractual payment. You're behind the lender it's almost guaranteed in most companies. There's a little exception that I'll talk about later, where if you're the lender to a company and you're charging 10%, and I'm the equity investor behind you, I should be charging more because I have to wait for you to get paid before I get paid. So if your argument is debt is cheaper, it always is going to mean that you're going to borrow money. But here's why it's an illusion. If you take out the tax effect, and that's a real effect, here's what happens when you as a business go out and borrow money. Think about your business as having 100 units. So let's start off the business and let's define risk in units of risk. You have 100 units of risk. It comes from the business you're in, you're cyclical, you have a lot of fixed costs, it's 100 units of risk. If you're all equity funded, let's say you have 100 shares, each shareholder bears 1 unit of risk, right? Now let's play a game. Let's say this company goes out and borrows money at a rate that's lower than their cost of equity. At first sight, this looks great, right? But think of what happens to 100 units of risk, they're still there. Borrowing money doesn't change the fundamental business risk. Somebody has to bear them. So if I borrow money and I, let's say, remove 50 shares, so it's 50 shares and $50 of debt, you still have 100 units of risk, but they're now spread out among 50 shares. The risk of a business doesn't change when you borrow money. It just gets reallocated among the existing players. That's exactly what we're doing with levered betas. We don't think of it that way, but a levered beta basically takes a risk in a business and loads it up on the remaining shareholders. Yes? It will show up in your cost of debt, but that's a truncation risk, the risk that your business will not make it. But if you think in operating risk terms, even if you take, so even if you don't even factor in default risk, which actually is something that weighs in against debt, if you're just saying, look at the cost of debt and the cost of equity, you cannot make business risk go away by just borrowing more money. So that's one of the illusions of debt. Here's a second one. I want to dispense with it right away because this you should be able to address when somebody tells you this is the reason companies should borrow money. Interest rates are lower, therefore you should borrow more money. What's the problem with that logic? First, let's take the true part of that statement. When risk-free rates or T-bond rates go down, is your cost of borrowing lower? Absolutely. Your cost of debt is going to be lower. So why doesn't that make debt more attractive when interest rates are low? Exactly, right? It's like a tide in a lake, or when the tide goes down, both the cost of equity and the cost of debt go down. In fact, I will argue at lower rates, equity actually becomes more attractive relative to debt if you're adjusting both numbers for that risk-free rate. So let's get those illusions out of the way because we want to talk about what the real benefits are and what the real costs of borrowing. The rest of this class is about this qualitative trade-off. We'll make it quantitative in the next class, so don't worry about it being fuzzy. Let's start with the fuzzy part. The biggest, the most dominant benefit of borrowing money is a tax benefit. We're going to talk about how much the tax benefit is, why it might vary across countries and companies, and how it plays out in financing. The second benefit, and it's a lesser benefit, is there are some companies where borrowing money can make the company more disciplined about the way it approaches decisions in the business. That sounds like a weird thing to say, but I'm going to give you a very simplistic example where you can see how borrowing money can make managers a little more careful about picking projects. Tax benefits and added discipline. It's got to be weighed off against three costs. The first is When you borrow money, no matter who you are as a company, you could be Apple and you could go out and borrow money, your chances of failure, bankruptcy, increase. For Apple, it might go from 0.001% to 0.003%, but there is no company where borrowing money reduces your bankruptcy risk. It might do very little, but it's always going to push it up. The question is how much. We're going to get more explicit about what exactly is bankruptcy cost. And most of us, when we think about bankruptcy costs, think about what happens after a company goes bankrupt. It goes up, ends up in the legal system. There are lawyers involved, there are costs involved. I'm going to argue that the real costs of bankruptcy start to rise even before that happens. If people think you're in trouble, like what people, your customers, your suppliers, your competitors, you're in trouble, because it creates this ripple effect that can affect everything you do as a business. It's called indirect bankruptcy costs. So we'll make that more explicit. So that's the first problem. The second is what's called an agency cost. In economics, we love to create these buzzwords. But agency cost is just a buzzword. You know what an agency cost is? When you ask somebody else to do something for you, notice that it's never done the way you'd like it done. Why? Because that person doesn't care about your interests as much as you do. So you're at a group meeting, you want a sandwich. One person volunteers partly because he or she's too lazy, say, I'll go pick up the sandwiches. It's easier than working on a spreadsheet. And you each give your orders. And you say, you want ham on dry, no mayo. What do you get? Turkey on wheat with lots of mayo. This person got there. What did he say again? Who cares? He might be allergic to mayo, but then he will call the ambulance if that happens. That's an agency cost. Life is full of agency costs. And when you talk about debt and equity, here's the agency cost. You are the owners of the company, the equity investors. When you had no debt, you ran the company. It's all about your interest, right? And your interest is upside and downside. As an equity investor, you want to go wherever you can get the highest returns adjusted for risk. Now a lender comes into the company. The lender's interests are very different, right? They don't get the upside of growth. So given a choice between this extremely lucrative high net present value growth project and a much lower net present value safer project, the lender is going to take the safer project. That's an agency cost. And you're saying, let the lender bear. The lender never bears these costs. You as the equity investor will bear these costs because the lender is going to find a way to pass those costs on. That's the agency cost. We'll get explicit about how that shows up in companies. And finally, we talked about flexibility in the last class. Remember, we talked about we live in a world with the COVID example where flexibility has become a much more critical variable. When you borrow money, you make yourself more inflexible. You're locking yourself into payments. And if bad things happen, it's much easier to step back. It's nice to have the capacity to borrow money and not use it. It's like setting aside something for a rainy day. So what I'd like to do is take each of these pieces and talk about what drives how big that piece is going to be for your company. And then we'll bring them all together in a final trade-off, and we'll ask qualitatively, looking at your company. Think about the company in your project. What do you think this trade-off is going to lead to for your company? High debt ratio, an average debt ratio, or a low debt ratio? Let's start with the tax benefits of borrowing. As I said, in much of the world, the tax code is tilted towards debt. And I've always wondered about this, because if you look at every religion in the world, what does it tell you about debt? That lenders are sinners. Borrowing is how you get into trouble. In fact, there are some religions where you could not lend money. In fact, Islamic finance, you can't lend money if you have a strict reading of Islamic, because lending money is considered to be sinful. So he's saying, how in every religion invades against debt are the tax codes tilted towards debt? Here again, history plays a role. When you think about the US, and you think about how the infrastructure of the US was built in the second half of the 19th century, railroad companies, they had to go build railroads. This was before equity markets came into play. So governments used to give sweeteners to companies they'd give the land away. And when the tax code got written, they wanted companies to keep investing. So when the tax code got written in 1913, 1915, the phone companies were starting to build up. And they said, how the heck are we going to raise capital to grow? And the government, the government still does it, right? Tries to put things into the tax code to make companies invest more. And we can debate whether that's a good idea or not. But this started right at the start of the tax code in the US. When corporate tax codes were written, government said, we need to get companies investing. And one of the ways we can do that is to put in a tax benefit to that. It stayed because once something gets embedded in the tax code, it's tough to take it out. But whatever the reasons, when you borrow money, I give you an advantage. Interest expenses are tax deductible. As opposed to what? When you use your own equity. What do you get to keep? You get to keep after-tax income. So when I pay dividends, it comes out of after-tax income. So the first and the biggest benefit of debt is a tax benefit. And the magnitude of the tax benefit is going to be a function of your marginal corporate tax rate. Remember why? Interest saves you taxes at the margin. So it's not a function of your effective tax rate. It's what you pay at the last dollar of income. So let's make an obvious statement. The higher your marginal corporate tax rate, the greater the benefit to borrowing money. So let's think about, how this will play out. First using companies, and then we'll talk about countries. If you look at how the real estate business in the US is structured, there are two ways you can play the real estate game. One is to create a real estate corporation, a traditional company where you pay taxes on your income and you get to keep after-tax income like every other company. But starting in the early 70s, you're also allowed a second choice, which is to create what are called real estate investment trusts, REITs. What makes REITs unique is they're pass-through entities. What does that mean? REITs don't pay corporate taxes. You think, this is great, let's start a REIT. But there's a catch. What's the catch? In return for not paying corporate taxes, what are REITs required to do? Distribute almost all of their income. It's 95% of their net income as dividends. You're saying, how does it help the IRS? The minute those dividends get paid, what does the IRS do? It comes looking for taxes from you. One way or the other, they collect taxes. So don't feel sorry for the IRS. They'll find a way to tax you. But you have two different ways. So real estate corporations pay a corporate tax rate. REITs pay no corporate taxes. Holding all its constant. If I looked at the debt ratios for real estate corporations and compare them to the debt ratios for REITs, what should you expect to see? Real estate companies should have a higher debt ratio than REITs because they get a tax advantage. But there's a catch, right? That income gets paid out as dividends to individuals. So this could get complicated because if your investors are wealthy investors who pay individual taxes, might be higher than the corporate tax rate, there might be a case where a REIT can end up borrowing money, not because it gets the tax benefit, but indirectly its investors do. But in contrast, if you have another REIT where its investors are tax-exempt pension funds, you get the best of both worlds. You don't get taxed at all. If you're thinking about how much debt a REIT should have, you might have to look at who the investors in the REIT are. Because in a pass-through entity, it's not like you're evading taxes. You're just being taxed at a different rate at the individual level. You have a question? Zero. It should have not debt if its investors are all taxed. See, that's why it's not that easy. I'll tell you a place where it's easier. I told you there are some parts of the world where there's no tax benefit to debt. So where in the world, when you borrow money, you're not given a tax benefit? Much of the Middle East, any country following Islamic law, strictly, you will not get a tax benefit for that. And this has always puzzled me because if you look at Middle Eastern companies, you remove the corporate tax benefit from debt, what should you expect to see? Little or no debt. I can understand a little debt because your working capital needs, but there should be very little debt. But if you look at Middle Eastern companies, at least the public companies I see, they tend to carry much more debt. So why do you think that happens? Why, if you're removing the tax benefits of debt, do these companies still borrow money? Well, you got to disguise it and call it something else. It's like this kabuki dance. You don't call debt debt, you call it tortillas. You don't call interest expense, you call it cheese. So I'm just being facetious, but basically you will not see it called debt on the balance sheet. No. Explicitly, you're not supposed to pay interest expenses. So you're Aramco, if you had interest expenses in your income statement, somebody's going to freak out. So what do you have to do? If you borrow money, you'll call it something else. They do borrow money, but you will see debt on the balance sheet. In fact, if you look at the United Arab Emirates, where it's not as strict, you will see debt on the balance sheet, even though there is no tax benefit debt. And that raises the question, why would you borrow money if there's no tax benefit debt? Yeah.
Still, the cost of debt is lower than the cost of equity. And if you're looking for like when you're trying to balance it, I know it's not.
When we do the optimal cost of capital, you're going to see the optimal debt ratio for a company. Its cost of capital is minimized. If you remove the tax benefit, it's always 0%.
Even if the high intensity assets.
It doesn't matter. It doesn't matter. If you, it's one of the absolutes in finance. You remove the tax benefits of debt, the cost of capital go to 0%. But what's the alternative to debt? You raise equity, right? To raise equity, what do you have to have? A capital market the problem in the Middle East is the equity capital markets are so underdeveloped that you often are driven to borrow money, even though it is not the best way. It's a little insane, if you ask me, but the way governments compensate in the Middle East is they act as co-guarantors almost of corporate debt, which means that if you borrow money and something bad happens, rather than you go under, this is the advantage of having a lot of oil money as a buffer for companies. Most governments couldn't do it, but you see sometimes. Let's do one other example. If you look at publicly traded companies in the US, obviously REITs pay no taxes. You know the other group of companies that are publicly traded that pay very low or no taxes? No, utilities pay big taxes, actually. Cruise line companies. You know why? Because they play this little game. First, if you look at where they're incorporated, a surprising number of cruise lines are incorporated in Liberia. How many Liberians do you think go on cruises? Panama. What they share in common is it's a tax-exempt or a tax-free corporate location. But here's the catch, though. Usually companies can't evade taxes by putting yourself in Panama or Liberia because you get taxed on where you sell. So if you're an automobile company, you create your headquarters in the Cayman Islands, you sell all your cars in the US, you're still going to be taxed on where your income is derived. You know how cruise lines get around that? You get on a cruise ship. I've been on once, I never want to be in a cruise ship again, but you get on. For the first 30 minutes you're in the ship, nobody serves you alcohol or anything you have to pay for. Magically, around 30 minutes, things start to appear that you can pay for. You know why? Because you've crossed that, 12-mile, 15-mile, whatever point it is where you say, look, I'm on the high seas. I'm not in US territory anymore. So basically, their defense is our revenues come from somewhere there, the ocean. They can't tax us because we're nowhere. And it's in fact something that technology companies are able to exploit, right? When you go on, let's say you go on the Apple App Store, you buy an app. Where did that app get sold from? You're saying Cupertino or not really, right? It got sold in virtual space, and Apple can say our app store is in Ireland. And how are you going to contest that? The IRS has had this issue with tech companies because their sales happen this virtual space are like the cruise lines. Only the problem is they're 50 times, 100 times bigger. So when you look across companies, sometimes they all look like they have the same marginal tax rate, but there's these nuances that you got to think about that can lead some of these companies to a much lower debt ratios. Now, building on this across countries, we said the tax benefit for a company reflects the marginal tax rate, right? Now, the marginal tax rates vary across countries. Take Europe. The country with the lowest marginal tax rate of any substance is Ireland, 12.5%. And you got Germany at the other end, 29%. Let's look at European airlines. They all lose money, so it's a bad example, but let's say they were making money. And you've got Ryanair, which is an Irish airline, and you've got Lufthansa, which is a German airline. Assuming they were healthy money-making companies, you'd expect Lufthansa to borrow a lot more money than Ryanair because of differences in tax rates. So when you look across the companies in your group, if they're all US companies, obviously this is not an issue, unless you have a cruise line in your group. But if you're looking across companies in different countries, you might want to tag the marginal tax rates for those countries, because that might explain some of the differences you see in debt ratios. One final point before we leave this. There's another that we talked about cruise lines, we've talked about, tech companies. There's another group of companies which, at least in the near term, and when I talk about near term, I'm talking about 3, 5, 7 years, have marginal tax rates of 0. What am I talking about? What types of companies? If you have big NOLs, even if you start making money, you know what you can use those NOLs to do? Shelter your taxes. So if you take this proposition to its logical extreme, companies with big net operating losses should borrow less money, because what's the point? You're not going to get a tax benefit for the next 5 or 7 years. Why go borrow money and add to your NOL? So that's the first stop. Any questions on the tax benefits of debt? Now, of course, corporate marginal tax rates don't stay fixed in perpetuity. Why? Because governments often revisit the tax code and try to fix it. Prior to 2017, the US had the highest corporate marginal tax rate in the world, close to 40%. Because when you think about US marginal tax rates, you got to start with the federal tax rate, which then was 35% before 2017, add state and local taxes. The US had the highest marginal tax rate. Now, I'm not going to debate the politics, the 2017 corporate tax law, but let's look at what it did to the marginal tax rate. It lowered the federal marginal tax rate from 35% to 21%. In addition, it actually put limits on how much interest could be tax deductible. If you're, if it exceeded your EBITDA, basically there are all these rules. 2017 tax law brought down both the marginal tax rate and put limits on the deductibility of interest expenses. As I said, I want to debate, was that a good idea or a bad idea? But holding all else constant with that change, what should you expect to see happen to debt ratios at US companies now that that changes? They should go down, right? I've been tracking the total debt at US companies. They've come down, but it's very, very, very small. And this is something you got to factor into corporate finance. Change doesn't happen overnight. Why? Because of inertia. If you're a company that's always borrowed money, you don't suddenly stop and say, oh my God, the tax code has changed. You do it because that's what you've always done. Sounds like a very lazy way to run a business, but it's human nature. So I'm going to keep tracking the debt ratios. The only problem is the corporate tax rate could change again, right? At least the earlier proposals last year were, let's move it back to 28, and now it's, I don't know, I don't even know what the new tax code, the new tax proposal contains. But anytime you move the marginal tax rate, you are affecting how much companies can borrow. So that's a tax benefit of debt. Let's move to the second potential reason you might borrow money. Debt can sometimes make a company more disciplined about the way it takes projects. To understand this argument, let's go back to the very first few sessions in this class. We talked about managerial interest versus stockholder interest, right? That sometimes they diverge. That in companies where managers run the company and there's very little accountability, managers sometimes do things that are not in the best interest of stockholders. Like doing what? Like taking bad projects sometimes because they get some side benefits from the project, or it makes them feel more comfortable. Now, I can't make managers stop taking bad projects, but I can raise the consequences of them doing so. Let me explain. If you're a manager in a mature company with lots of earnings and cash flows, and you have no debt, and you take a bad project, who's going to notice? Right? It slips in there. It becomes part. It's not like you face any personal consequences from making mistakes because the company is big enough and you really have no contractual claims that are going to expose your mistakes. You can make mistakes and get away with it. When you borrow money, what have I done? I've made you commit to making $100 million, $500 million in interest expenses. Now, if you take a bad project, what could happen? Your earnings could actually drop below that interest. In worst case scenarios, you could go bankrupt, you could lose your job. I'm saying, look, you don't care about me as a shareholder, but I'm going to make you care. Sounds like an extreme way of getting somebody's attention, right? In fact, I call this the Volvo argument for debt. Let me explain. Let's say it's 5 years out, you joined an investment bank, you moved up the ranks, you moved out of New York, you own a house in the suburbs, big house. You got 2 dogs, 2 cars, 2 spouses, whatever makes you happy. And every day, you don't like to drive. You take the train into the city. You've got 2 cars. Your first car is a Volvo 960 extra armored. You know what I'm talking about? Side airbags. It's like driving a tank around town. Your second car is some kind of a tin trap. I don't want to insult any of your cars, so I'll use a Trabant. Somehow you got your hands. You heard of Trabant? There used to be the East German cars, where around 55 miles an hour, your car started to shake. At 70 pieces would start flying off. So basically, you have 2 cars. Your first day is your lucky day. You get to drive the Volvo into the train station. Live only 5 minutes away, but you're too lazy to walk. You drive your car to the train station, you park your car there, you get on the train at 8 o'clock in the morning. You go to work. You work all day, you work all evening, you work all night. How else do you think you can afford the big house and the 2 spouses and the 2 cars? At 10 o'clock at night, you come back. You drag yourself off the train. You're exhausted. You crawl to your car. You get in your car. You start to drive home. It's only 5 minutes away, but between the train station and your house, there's a traffic light. You get to the top of the hill, the light turns red. You say, oh, drat. I'm censoring as I'm going along. Probably fouler language is coming on. And as you sit there watching the red light, illegal thoughts start to cross your mind. Saying, what if I ran that light? Now, first thing you worry about is getting a ticket, but this is 10 o'clock in the suburbs. The police have all gone home. You're not going to get it. The second thing you worry about is getting hit. Now, initially that stops you, but then you remember you're in your Volvo extra armored. You get hit, you get a little dent on the side. The other guy's all crumpled up, but you don't care about that guy. You run the red light. You make it home safe. Congratulations. Next day, you repeat the process, but today you're in your Trabant. You rattle to the station, you park your car, you go off to work, 10 o'clock at night, you come back, get in the car, you drive up to the top of the hill, light turns red again. It's like a conspiracy. And you get ready to hit the gas pedal to run through the red light. Then you remember you're no longer in your Volvo. You're saying, if a bicyclist came along and hit me, I could roll off the road. Let me stop. You're saying, what's this got to do with good projects and bad projects and debt? Think of the Volvo as an all equity funded company. Think of the airbags as cash cushions. Think of the red light as a bad project. Why did you run the red light or take the bad project? Because you weren't afraid of getting, I protected you so well that you basically didn't care. Think of the Trabant as the same company, stripped off its cash, forced to borrow money. And think of why you ran the red light, because the consequence of running the red light, taking the bad project, you'd have felt it. And even Trabants come with air balloons. They're not big enough to be bags. Okay. But the reason I say that, in the 1980s, a guy called Mike Jensen. Remember the word Jensen? Does that remind you of something? Jensen's Alpha, the same Mike Jensen. He likes to attach his name to pretty much everything he creates. Made an argument for debt that he called it's called the Jensen free cash flow argument for debt. This was to explain leverage buyouts that were starting to happen in the 1980s. He said the reason we see leverage buyouts is because you need discipline. And I never quite bought that argument because that goes well beyond you should have consequences. Here, it's almost like taking that air balloon in your Trabant and replacing it with an air knife. You know what an air knife would be? You hit something, a knife comes out of the steering wheel. Would you ever drive that car? Probably sit in your driveway saying, I'll walk to the station. That's what happens when you borrow too much money. Every mistake you make could blow up the company. Somewhere between the Volvo and the air knife, there's a happy compromise. But that's the added discipline argument. Let's say if it's 6, because I'm going to give you 3 groups of companies. And I want you to tell me in which of these 3 groups, this argument for debt, the added discipline argument, would be a good one to make for that company borrowing money. The first, so when I say conservatively financed, basically these are companies that are primarily equity. Right now, none of these companies have debt. And one of these 3 groups, you can use the added discipline, and I want you to isolate which one it is. The first is companies with very little debt, but they're privately owned. Is the argument for added discipline a good one? If you need to borrow money to make yourself disciplined, it's your business. You have deeper problems. Now I can't solve. It doesn't make sense, right? So privately owned companies, it's kind of absurd to argue you need to discipline yourself by borrowing money. How about publicly traded companies where stock is splintered across lots and lots of investors? Why? In fact, this is obviously the case where added discipline makes sense. Why? Because none of these stockholders have enough of a stake to make a big deal about the fact that you're taking big projects. If they don't like it, they sell the stock and move on. Which is one reason if you have a company where you have an activist investors looking over the manager's shoulders, you don't need debt to make you disciplined. That person is going to make you disciplined. I'd love to sit in on the next Twitter board meeting. I want them to telecast it. You imagine the ratings for that? It'd be like a reality show. Because remember what we said about Steve Jobs at Apple? Not a go along, get along kind of guy. I mean, Elon is Steve Jobs on steroids, right? It's definitely not go along, get along kind of guy. Twitter's management is going to think a lot more seriously about every investment they make from this point on. Because there's accountability. So the question is accountability. There's some other, because borrowing money to make companies accountable is a very inefficient. It's a bludgeon. You don't want to use it if there's another way, but you can see why in some companies, borrowing money can benefit you. So that's the added discipline. Any questions? Let's talk about bankruptcy costs. There are 2 components. So when you look at borrowing, you're asking, what's my expected cost of bankruptcy? And there are 2 pieces to the puzzle. One is the probability that you will go into, go bankrupt. And that's going to be a function of how volatile your earnings are and whether you can make interest payments. So if you have nice, stable earnings, obviously that probability is going to be lower than for another company. So when you think about your company, again, think about, does it have stable earnings? If it's stable earnings, the probability is lower. But that gets multiplied by the cost of bankruptcy. And there are 2 components to this cost. The first is what I call a direct cost. The direct cost of bankruptcy is what happens once you declare bankruptcy. Once you declare bankruptcy, where do you end up? In court. Very efficient system, right? I remember when I became a citizen of the US in the 1990s. About 2 weeks after I became a citizen, I got a letter in the mail reminding me of my duties as a citizen. Guess what I got? Summons to jury duty. And I was so naive. I was actually excited about the prospect. So I circled the day on my calendar. I showed up at the courtroom expecting balloons and a parade. This bored-looking woman sitting behind a table said, what do you want? I said, I'm here for jury duty. She said, go sit there. I said, okay, what do I do? Look at that terminal. So what am I looking for? Your number. I said, what if it doesn't show up? You come back again tomorrow. I said, I can't keep coming back every day. She said, don't worry, we pay $10 a day. So that settles it. I'll come back for the rest of my life. But that kind of gives you a window in how the legal system thinks about the time value of your money and my money. There's only one person or one group of people in that system who actually are okay with the time because they get paid based on time, which are the lawyers. Everybody else, doesn't matter. You can spend a year here. What's the big deal? It's an incredibly inefficient system. That's what you end up in. There was actually a study that looked at railroads that went bankrupt in the 1970s in the US, and pretty much every US railroad went bankrupt. That's how Amtrak was actually created, is of bundling these bankrupt railroads. And it asked a simple question: after they declared bankruptcy, what percentage of the assets was actually available to service the lenders? Because after all, their claims are what, you know what they found? 50% of the assets ended up. You know what happened to the other 50%? Legal fees and leakages. I wouldn't even identify the leakages. Lots of leakages. My son, my second son actually works at an accounting firm. I won't name the firm. But about 3 years ago, when he first started, or 2 years in, I said, what are you working on? He said, I'm working on the Lehman bankruptcy. I said, what? That was in 2008. 2019, they were still working on the Lehman bankruptcy. You know that collectively, lawyers and accountants collected $2.5 billion in fees from the Lehman bankruptcy. So when you go bankrupt, that's what I worry about. It's not that you've gone bankrupt, but half your assets disappear into thin air. That's a direct cost. But if that were the only cost, companies should borrow more money, because your property is low, you bring that in, you say that's not a big deal. The cost that really worries me is the indirect cost. What is the indirect cost? If people think you're in trouble, it changes the way they interact with you, right? If you're a customer and you read in the newspaper that a company is in trouble, you might be less willing to walk into that company. Depending on the business, it'll affect your willingness, but it affects whether you buy the company's products. If you're a supplier and you hear the company's in credit, what do you start demanding? Not 60-day credit, pay me in cash. If your employees think you're in trouble, they're just checking out websites or where can I get my next job, because they're not sure whether you'll be. If you get into the spiral, you can very quickly find yourself in a debt spiral. That is an indirect bankruptcy cost. And in some businesses, it can be immense. You don't even want to get close to that spiral starting. So when you think about how much companies should borrow, first, companies with more stable earnings should borrow more than companies with more volatile earnings. But more critically, companies with indirect bankruptcy costs that are huge borrow less than companies without those costs. You're saying, shouldn't every company be affected by indirect bankruptcy costs? Well, to a degree, but to different degrees. In fact, to show how these costs can vary across companies, I want you to think about three companies here: a grocery store, an airplane manufacturer, and a high-tech company. And a high-tech company can be a software company or a hardware company. Maybe the answer will be different. Think just purely in terms of indirect bankruptcy costs. In which of these companies are the indirect bankruptcy costs likely to be lowest? Go ahead. I'm sorry? Well, it could be, but if you have software, have you ever had software where the company goes out of business? And then you try, Apple updates its operating system, all your files stop working. I've had that happen. I'm sure you've had that happen as well. So with software, you worry about upgrades. With hardware, of course, you buy a computer where the company goes out of business. Who knows whether you can. So you do it, maybe not as much as an airplane manufacturer, but with a high-tech company, you do worry. Have you ever walked into a grocery store, stopped at the door and asked, is this a AAA rated grocery store or a triple C rated grocery? You frankly don't care, right? It's not like you're planning to bring the lettuce back in 5 years. You're going to grab your lettuce and tomatoes and whatever. You're going to walk out. There's no serious long-term interaction you have. It's true they have supplier issues, but grocery stores can be triple C rated and still operate. But imagine being an airplane manufacturer. You know what a typical contract for Boeing looks like? That Singapore Air has agreed to buy 15 aircraft over the next 10 years. United is talking about buying 100 aircraft. I don't know who they're going to pick, but if they pick Airbus and say 100 aircraft over the next 20 years, is there any chance you as an airline are going to enter into a contract with an aircraft manufacturer that's teetering on the edge of disaster? I mean, imagine having aircraft and nobody to service them or not being able to get the parts. For an aircraft manufacturer, the perception of default can be deadly. That's why on March 23rd of 2020, when I valued Boeing, and Boeing got into trouble, not because of some fault of its own, but because COVID shut down the entire airline business. They clearly created some of their own problems with 737 MAX and what they did with that. But on March 23rd of 2020, they were really close to the edge. Because once you hit that, the whole thing kind of spins out of control. So if I were to rank these companies, I would put grocery stores as the least indirect bankruptcy costs. You should expect grocery stores to borrow more money than an airline, even if the numbers look exactly the same. Technology in the middle, depending on what kind. So it's true, some kinds of technology might not care. I mean, for Uber, when you call your Uber and say, let me call Uber, its financials look more solid than Lyft. I don't think I've ever checked the financials when I do it, because as long as the guy shows up in 5 minutes and I get home in 35, I frankly don't care if Uber goes bankrupt tomorrow. Maybe they won't collect my money because they went bankrupt. Now, so there are some tech companies where you really might not care, but some tech companies where you're going to care more. But the more you have a product that requires long-term servicing, long-term interaction, the more you care about that company being around, the more you care about the company being around, the greater the indirect bankruptcy cost. Which brings me to agency costs. As I said, agency cost rises anytime you have two groups of people with very different interests. And that's what you create when you have a company with debt and equity. Lenders want safety. They want to get their claims, the contractual claims. Equity investors are much more interested in growth and upside. So you've got different claims. And remember, early in the class, I said, if you're a lender, a trusting banker is the word I use. A trusting banker, I said, is an oxymoron, because you will either be trusting or a banker. You can't be both. Because if you just say, look, you look honest, I will lend you the money, no strings attached. As an equity investor, I'm going to go out and do strange things for the money. So what do non-trusting, prudent bankers do? Write covenants. You can't do this, you can't do this, you can't do this. You can't take a big project unless we give the okay. You can't go out and borrow more money unless we sign off. That's what covenants are. In fact, to understand the two ways in which you deal with agency costs, most of you look to, anybody here have kids? Okay. How old are your kids? 4.5. Have you ever had a babysitter look after them? With COVID, you probably have not. So you had, right? It's a huge agency cost problem. First, if you live in much of the country now, finding a babysitter is this hugely involved logistical exercise. You got backups and backups and backups just in case it falls through. The babysitter arrives, finally, you're paying like $15 an hour. That might be cheap. You give very specific instructions. You say, look, we're going for dinner. We'll be back in 2 hours. Don't feed the kids ice cream or sweets after 8 o'clock because they'll bounce off the walls. You leave 7 o'clock. The babysitter gets comfortable on your couch, starts watching whatever, Gossip Girls or whatever he or she wants to watch. At 8:30, kids sense weakness. They come down and say, we want ice cream. Now, the babysitter faces two choices. One is, you can fight the kids and say, no, your parents said no ice cream, but then it makes you can't watch the rest of the show. The other is you say, kids, take the carton of ice cream up. Don't come back down. And you send them back up. 9:30, you come back home. You pay the babysitter. She seems to be in a hurry to leave. She slams the door. And then you hear the sound of kids bouncing off the wall. So you go up. And you realize you've now lost a night of sleep. It's the reason why you stop going out. Because there are two ways you deal with this agency cost problem. One is you factor in the cost. You say, look, when we go out, we'll have a nice dinner, but no sleep for a night. So you built the cost in. Or you start to put in cameras all over your house. And you watch the babysitter while you're at dinner on your phone. She's giving them ice cream. We need to zap somebody, the kids or the babysitter. Maybe you've set up these electronic devices that zap people. That's a punitive mechanism. Borrowers do, if you look at lenders, they do the same thing, right? They write in covenants, they hire lawyers, and guess who pays for the lawyers? It's not the lenders, it's US borrowers, or they assume you will do crazy things with their money and charge you a much higher interest rate. Either way, you bear the cost, and the greater the agency cost, the less you should borrow. Now you might ask, why would agency costs vary across companies? But to think about why they would vary across companies, I want you to think like a lender. You're lending money to a company, and I want you to think about which of these companies you're most scared about what people will do with your money, and which of these companies you might feel a little more comfortable. The first is a tech firm. The second is a large regulated utility. The third is a real estate corporation. Let's start with the easy one first. Which of these companies do you feel most comfortable lending money to, and why? Yeah. And tell me why. And it's a regulated monopoly. In addition, regulated utilities have restrictions from the government on other businesses. They can't go out. So the government steps in and acts as an enforcer. You, when you lend money to a regulated utility, face relatively, and you can see the big plant they've built. And staying on the theme, for whatever reason, lenders often feel more comfortable if they can see. There's a reason real estate developers are capable of borrowing the money they do, right? Because you build a building, the bank will look, that's the building that my loan did. It makes you feel strangely comfortable, even though it shouldn't. And if I cover the building with gold, you lend me even more, saying that looks even better. Real estate has always been able to borrow money because of its physicality. This might not be fair, but if you're lending to a technology company or a pharmaceutical company, and they say they're doing R&D, how the heck do you know? They borrow the money, they hire a bunch of homeless people, put white coats on them, say, walk around this building, look busy. You have no way of knowing. It's not like you can tell real research from fake research. If you're a company with primarily intangible assets, you tend to borrow less because people worry more. And people worry more, they charge you higher interest rates. Those of you valuing the big tech companies, you look at their debt ratios. One of the things you're going to notice is they borrow way less than mature companies and other businesses. Some of it might have to do with unwillingness to grow up, but a lot of it is, if we go out and borrow money, these constraints that they put on us because people worry, just handicap us. Which brings me to the final potential advantage. We talked about tax benefits added to potential disadvantage. You've got bankruptcy costs, agency costs. But here's something to factor. Even if you have the capacity to borrow money, if you go ahead and use it, you've essentially reduced your flexibility for the future. It's nice to have the capacity to borrow money. A regulated utility might not care. You know why? Because their investment plans are pretty much set in stone. It's not like something unexpected is going to land on their laps. So that could be changing with green energy. But historically, you say, who cares about flexibility? But you see why an Apple or a Google or a Netflix should be more careful about borrowing money. Today, Apple is a great cash machine, but all of that depends on this one product, right? Which is the iPhone. You live from iPhone to iPhone. What if the iPhone 14 crashes and burns? All of a sudden, you can't from a company that could afford it. So if you're a company that's uncertain about what the future will bring in terms of investment opportunities, you're going to hold off on borrowing just in case. So let's bring that all together, and let's see if managers actually think about all these issues when they go out and borrow money. I don't have much trust in surveys, so I'm going to set that up front. But this is a survey where managers were asked, when you go out and borrow money, what are some of the factors that you weigh in? And it's ranked from most critical to least critical. First was maintaining flexibility. So that final factor, a lot of CFOs, when they think about borrowing money, that's a big factor. Second is long-term survival, which is just another word for bankruptcy costs, right? Third, predictable source of funds, because it's nice to be able to go back to the same place over and over again. Maximize stock price in the middle, right? Maintain financial independence, maintain a high debt rating, because I think they're lying on the seventh one. It's probably the most critical reason, but you can't say it because it makes it look like you don't deserve to be a CFO. Because how satisfying is it? Why do you borrow money? Because everybody else does it. So I think a part of this is cosmetically, it doesn't sound good. It's at the bottom of the list. But the trade-off there is, if you think about all of the issues, they're all in those factors. So I'm going to pull together everything from the last 20 pages and put it on one. Think of it like a balance sheet of debt. You've got the benefits of debt, added tax benefits, depending on your marginal tax rate, added discipline, depending on how much as a company, you need debt to keep you disciplined. You got bankruptcy costs, agency costs, and financial flexibility. I'll state the obvious. When you look at your company, if the costs exceed the benefits, you shouldn't borrow the money. If the benefits exceed the costs, you should borrow the money. Stating the obvious, but you can already see the framework, and I'm going to use that framework. It's a very qualitative, fuzzy framework to at least make a judgment on what I would expect my companies to be doing. Let's take Disney. Tax benefits, pretty high. They're a US company, at least in 2013, the marginal tax rate was 40%. Big tax benefits. Added discipline, well, it is true Disney doesn't have a lot of institutional investors or activist investors, but it does have, a big investor. It was Lorraine Jobs, but she's probably not that activist. So maybe added discipline can be a factor, but only to an extent. But tax benefits are clearly big. What about bankruptcy costs? Well, if you look at the different businesses, you look at the earnings, they're relatively stable because they're not just a movie company, but they also have these cash flows from theme parks, so relatively stable earnings. Agency costs, well, if you're a lender and you're lending to Disney, depends on what they claim. And remember, debt is fungible, right? So they will always claim it's for building that big theme park, building infrastructure. And flexibility, well, Disney's a pretty mature business. And in 2013, the entertainment business looked pretty settled. You know why I'm emphasizing that, right? Because in the following years, Netflix kind of upended the business. So this might be very different today when you look at streaming becoming much bigger part. So if you look at the trade-off, I would expect Disney to be capable of borrowing a reasonable, not utility level debt, but a reasonable amount of debt. In contrast, think about Baidu. Young company, high growth company, gets its revenues from a search engine. Tencent and Alibaba are kind of thinking of ways to get those revenues away. It's a company where everything could change pretty quickly. The tax benefits will still be there. They're a money-making company in China, 25% marginal tax rate. Not much in terms of added discipline because the founder of the company is actually the CEO. If you need discipline as a founder to keep you on track, then there's something wrong with you. I would expect, given the kind of company Baidu is, to have the lowest debt ratio. If you work through Vale, big tax benefit because the corporate tax rate in Brazil is 34%. And if you think about risk here, it comes from the commodity price moving. That's always an issue with commodity companies. As iron ore prices get more volatile, you should expect all iron ore companies to borrow less money. But to the extent it's the largest iron ore mining company, it's a mature company, gets a big tax benefit, you'd expect it to borrow again. Notice that we're fuzzy, reasonable. What does that mean? It's not enough. We're not done with this yet, but at least as a starting point, we're getting a sense of what you'd expect to see. And Tata Motors, you probably expect different debt ratios for Jaguar Land Rover and Tata Motors, depending on how fast they're growing. But the pieces that you're looking at remain exactly the same. So what I'd like you to do is take your company and start thinking through these purely in qualitative terms, right? What's your marginal tax rate? Is this the kind of company and remember, much of the work you've already done, right? When you looked at the shareholding for an earlier part of the project to see where the power lies, you can go back and look at that same shareholding to ask a different question, which is this the kind of company where discipline might need to come from debt? For the bankruptcy costs, look at their earnings over time. How volatile are the earnings? For the agency costs, what kind of assets do you have? You have a technology company. Think like a lender again. Would I feel comfortable lending to this company? And finally, in terms of flexibility, if you're in a business which is in constant change, so I'll make a statement. Given how much disruption has affected even businesses that we thought were mature, I would expect companies today to borrow less than they did 30 years ago. They might not be doing it because they're still driven by inertia. But I'll give you my favorite example for this. If you think about telecom companies, what allowed them to borrow money in the 20th century? They were often building into a monopoly, right? You put the cable line in, it's your only choice. Therefore, your revenues were stable. There was no threat. The assets were physical. You could borrow money. Utilities are among the highest debt ratios of any companies. Today, you think of a telecom company, you think of Verizon, you think of AT&T. You can expand that to think about other telecom companies. The business has changed, right? It's no longer a regulated monopoly because technology has removed that monopoly feature. Now I'm switching from Spectrum to AT&T fiber, when I get back home tomorrow in California. And I'm able to do that now. 20 years ago, if you didn't like the cable company, you bitched about it, you moaned about it, but there's very little you could do about it. I think telecom companies have become more technology companies and regular. So what should I expect to see happen to their debt ratios? If I were running a telecom company, I want to bring the debt ratio down. I might not be able to do it overnight, but running a telecom company today using debt ratios that phone companies use in the 20th century, it's a recipe for disaster. And I'll leave you with one final example. Sector that has a lot of debt is the airline business. I've never understood this. Your fixed cost structure is already sky high. Why in God's name would you go out and borrow money? Their argument is, we need the money to buy the planes. Well, you can raise equity to buy the planes because this isn't working for you guys. Think of how much this business goes through this phases of bankruptcy and coming back from bankruptcy. But sometimes businesses change, but companies don't adjust their financing to reflect changing businesses. So I will leave you with that thought, and I will see you on Monday.